Question 1. Which of the following is a characteristic unique to variable annuities when compared to fixed annuities? A. Fixed annuities provide guaranteed interest rates while variable annuities do not. B. Variable annuities have set premiums and payout amounts. C. Fixed annuities allow investment in sub-accounts with equity exposure. D. Variable annuities have no risk associated with the underlying investments. Answer A. Fixed annuities provide guaranteed interest rates while variable annuities do not. Explanation: variable annuities are different from fixed annuities primarily due to the nature of their investment options. Fixed annuities offer a guaranteed interest rate, which means that the insurer promises a fixed return on the premiums paid. This guarantees a minimum payout. In contrast, variable annuities allow policyholders to invest in sub-accounts such as stocks, bonds, or mutual funds, so the return is not guaranteed and can fluctuate depending on the performance of the investments. Therefore, option A is correct, while the other answers are incorrect. B. Fixed annuities have set premiums, but the payout amount can fluctuate if linked to a market index. Variable annuities do not have set payout amounts because payouts depend on investment performance. C. Only variable annuities have sub-accounts with equity exposure. Fixed annuities do not offer this investment flexibility. D. Variable annuities inherently involve risk due to the market-linked investment options, unlike fixed annuities, which have a guaranteed return. Question 2. Which of the following is a mandatory disclosure requirement for annuity products in Missouri? A. Disclose the death benefit payout structure only for fixed annuities. B. Disclose surrender charges for at least 10 years after the policy is purchased. C. Provide a clear explanation of any penalties or fees for early withdrawal. D. Disclose the full market value of sub-accounts for variable annuities after the free look period. Answer: C. Provide a clear explanation of any penalties or fees for early withdrawal. Explanation: in Missouri, disclosure requirements are strictly enforced to ensure consumers are fully informed before purchasing an annuity. One key requirement is the clear disclosure of any penalties or fees for early withdrawal. These are critical aspects that affect the liquidity of an annuity and can influence a policyholder's decision. The Missouri Department of Insurance, Financial Institutions and Professional Registration (DIF) mandates this disclosure as part of consumer protection laws to avoid misunderstandings regarding the costs associated with accessing funds early. While the other answers are incorrect, A. Death benefit structures are not mandatory for disclosure in all cases and vary by the type of annuity. B. Surrendered charges must be disclosed, but the requirement does not specify a fixed period of 10 years after purchase. D. The full market value of sub-accounts is not a mandatory disclosure under Missouri law after the free look period. Disclosures focus more on fees and charges rather than market fluctuations. Question 3. Scenario-based. Mr. Harris is 65 years old and has recently purchased a deferred annuity with a 5-year accumulation phase. He is now considering withdrawing some funds to cover an emergency. He understands that there will be penalties for early withdrawal, but he is unsure about the details. What should Mr. Harris do to ensure he understands the full consequences of this decision? A. He should assume the penalties are minimal, as he is past the age of 591 WO. B. He should contact his insurance company to ask for a full breakdown of surrender charges and early withdrawal penalties specific to his policy. C. He should make the withdrawal without consulting the insurer because the policy does not have a surrender charge clause. D. He should ignore the penalties as they are not enforceable after the free look period. Answer: B. He should contact his insurance company to ask for a full breakdown of surrender charges and early withdrawal penalties specific to his policy. Explanation: the correct course of action for Mr. Harris is to contact the insurance company to clarify the details regarding any surrender charges and early withdrawal penalties. Even though Mr. Harris is 65, which is the minimum age to avoid early withdrawal penalties under IRS rules for tax purposes, the annuity contract may still impose penalties based on the terms and conditions set by the insurer. These could include surrender charges for taking out funds during the accumulation phase, which is typical for deferred annuities. Therefore, it is crucial for him to get specific details from the insurer about how these charges will apply to his situation. While the other answers are incorrect, A. Even though Mr. Harris is over 591 or annuity contracts often have specific penalties unrelated to age. Therefore, he should not assume the penalties are minimal without verification. C. Mr. Harris should never make a withdrawal without first understanding the penalties and charges. He could incur significant fees if he does not follow the contract terms. D. The free look period allows policyholders to cancel the contract for a full refund, but it does not apply once the policy is in effect beyond that period. The penalties for early withdrawal can still be enforced after this period. Question 4. Which of the following riders in an annuity contract is designed to ensure the annuitant receives a minimum level of income regardless of the investment performance? A. Inflation protection rider. B. Return of premium rider. C. Income rider. D. Death benefit rider. Answer: C. Income rider. Explanation: an income rider guarantees the annuitant a minimum level of income regardless of the performance of the underlying investments in the annuity. This rider is often added to variable annuities or indexed annuities to provide guaranteed minimum income that the annuitant can rely on, which can be crucial for retirement planning. The income is usually paid out over the life of the annuitant and may include options to increase payouts based on certain factors, such as inflation. While the other answers are incorrect, an inflation protection rider adjusts payouts to help keep up with inflation but does not guarantee a minimum income. B. The return of premium rider ensures that the policyholder or their beneficiaries receive at least the amount of premiums paid if the contract is surrendered or the annuitant dies, but it doesn't guarantee income. D. The death benefit rider provides a death benefit to the beneficiary but is not focused on income for the annuitant. Question 5. What is the primary advantage of an indexed annuity compared to a fixed annuity? A. Indexed annuities offer guaranteed returns based on an equity index, while fixed annuities provide stable, predictable returns. B. Indexed annuities guarantee higher returns regardless of the market performance. C. Fixed annuities offer the potential for greater gains than indexed annuities. D. Indexed annuities link returns to a market index providing growth potential with some downside protection, unlike fixed annuities. Answer: D. Indexed annuities link returns to a market index providing growth potential with some downside protection, unlike fixed annuities. Explanation: an indexed annuity links the return to a market index, e.g., the SP 500, allowing the policyholder to participate in market gains up to a certain cap or participation rate. It also provides some level of downside protection, as the return typically does not fall below 0%, no loss in a bad market year. Fixed annuities, on the other hand, offer guaranteed interest rates, meaning the returns are predictable but generally lower than what could potentially be achieved with an indexed annuity if the market performs well. Why the other answers are incorrect. Indexed annuities do not offer guaranteed returns based on an equity index. The returns depend on the performance of the index, subject to caps and participation rates. B. Indexed annuities do not guarantee higher returns. They provide a potential for higher returns with a cap, while fixed annuities offer a guaranteed return. C. Fixed annuities do not have the growth potential associated with indexed annuities because they are not linked to the performance of a market index. Question 6. Mr. Thompson, 58, is considering withdrawing funds from his non-qualified deferred annuity for a financial emergency. He is aware of the 10% IRS early withdrawal penalty. If he withdraws $15,000 in earnings, what would be the tax consequence? A. The withdrawal will be tax-free as it is from a non-qualified annuity. B. The withdrawal will be taxed as ordinary income and an additional 10% penalty will apply to the earnings. C. The withdrawal will only be subject to the 10% penalty and no taxes. D. The withdrawal will be taxed as capital gains, not ordinary income. Answer: B. The withdrawal will be taxed as ordinary income and an additional 10% penalty will apply to the earnings. Explanation: withdrawals from non-qualified deferred annuities are taxed as ordinary income because the premiums paid into the annuity were made with after-tax dollars and the earnings have been tax deferred. The 10% early withdrawal penalty applies to earnings, not principal, if taken before age 591 in accordance with IRS rules. Therefore, Mr. Thompson would owe income tax on the $15,000 in earnings, plus an additional 10% penalty for early withdrawal, while the other answers are incorrect. A. The withdrawal is not tax-free as the earnings are taxable. C. The 10% penalty applies only to earnings and taxes must also be paid on the earnings. D. Annuity withdrawals are taxed as ordinary income, not capital gains. Question 7. Scenario-based. MS. Carter, a 45-year-old investor, purchases a variable annuity with an income rider attached. Her agent explains that the rider guarantees a certain level of income at retirement, regardless of the performance of the underlying investments. However, MS. Carter is concerned about the cost of this rider. What is the most important factor she should consider in assessing whether the rider's cost is justified? A. The total premium paid for the annuity. B. The minimum guaranteed income amount and whether it meets her future income needs. C. The cost of the rider relative to the annual premium payments. D. The historical performance of the underlying sub-accounts of the variable annuity. Answer: B. The minimum guaranteed income amount and whether it meets her future income needs. Explanation: the income rider on a variable annuity guarantees a certain level of income regardless of the performance of the sub-accounts. When deciding whether to purchase such a rider, it is crucial to evaluate whether the guaranteed income will be sufficient for the investor's future retirement needs. While the cost of the rider, option C, is important, the key factor is whether the guaranteed income provided by the rider is adequate to meet her income goals in retirement. The guaranteed income is meant to provide financial security, so it should be assessed in relation to her expected expenses in retirement. While the other answers are incorrect, A. The total premium paid is relevant, but it does not directly address whether the guaranteed income from the rider meets Ms. Carter's needs. C. The cost of the rider must be considered, but it should be evaluated based on the level of guaranteed income it provides, not just the cost itself. D. The historical performance of the sub-accounts is not as important because the income rider guarantees a minimum income regardless of the investment performance. Question 8. Which of the following tax advantages is specific to qualified annuities compared to non-qualified annuities? A. The premiums paid into a qualified annuity are taxed at the time of contribution. B. The earnings in a qualified annuity grow tax-deferred and distributions are taxed as ordinary income. C. Withdrawals from a qualified annuity are tax-free if made after age 591 or D. Qualified annuities offer a tax deduction for premiums paid when contributions are made. Answer: B. The earnings in a qualified annuity grow tax-deferred and distributions are taxed as ordinary income. Explanation: the main tax advantage of qualified annuities is that the premiums are contributed with pre-tax dollars and the earnings grow on a tax-deferred basis. When distributions are taken, the earnings are taxed as ordinary income. This tax treatment allows for potential greater growth compared to non-qualified annuities, which are funded with after-tax dollars. While the other answers are incorrect, A. In a qualified annuity, premiums are contributed with pre-tax dollars, not taxed at the time of contribution. C. Withdrawals from both qualified and non-qualified annuities are subject to tax and a 10% penalty applies if withdrawn before age 591 regardless of the annuity type. D. Qualified annuities do not provide a direct tax deduction for premiums paid. They defer taxes on earnings until distribution. Question 9. Which of the following describes the free look period in an annuity contract? A. The period during which an annuitant can cancel the contract and receive a full refund, no questions asked. B. The time frame during which the annuitant can adjust the terms of the contract without penalty. C. The period in which the annuitant can make additional premium payments without incurring fees. D. The time during which the insurance company can reassess the annuity contract's performance. Answer: A. The period during which an annuitant can cancel the contract and receive a full refund, no questions asked. Explanation: the free look period is a standard provision in most annuity contracts that allows the annuitant to cancel the contract within a specified time frame, usually 30 days, depending on the state, and receive a full refund of the premiums paid, with no penalty or questions asked. This period provides consumers with an opportunity to reconsider their purchase without financial loss. Why the other answers are incorrect. B. The free look period does not allow for contract adjustments, only cancellation. C. The free look period does not allow the annuitant to make additional premium payments without fees. It's a period during which they can cancel the contract for a refund, not for making changes or adding funds without penalty. D. The free look period does not involve the insurance company reassessing the contract's performance. It is simply a grace period for the annuitant to evaluate their decision and cancel the contract if desired, without any financial penalty. Question 10. Which of the following is true regarding surrender charges on an annuity? A. Surrender charges are not applicable to annuity contracts. B. Surrender charges only apply if the annuitant withdraws funds before the age of 591 WO. C. Surrender charges typically decrease over time and may disappear after a certain number of years. D. Surrender charges apply only to fixed annuities, not to variable annuities. Answer: C. Surrender charges typically decrease over time and may disappear after a certain number of years. Explanation: a surrender charge is a fee that an annuity contract holder may incur if they withdraw funds before the end of a specified period, usually referred to as the surrender period. This charge typically decreases over time and may be eliminated entirely once the surrender period ends, usually after 5 to 10 years. The amount of the charge is usually a percentage of the amount withdrawn. While the other answers are incorrect, surrender charges are a common feature of annuities, especially during the early years of the contract. B. While surrender charges can apply if funds are withdrawn early, they are not limited to withdrawals before age 591, where they are tied to the contract surrender period regardless of age. D. Surrender charges apply to both fixed annuities and variable annuities. Let me know if you need further clarification or additional questions. Question 11. Which of the following best describes the accumulation period of an annuity? A. The period during which the annuitant receives regular income payments. B. The period during which premiums are paid and the annuity grows in value, typically through interest or investment returns. C. The time frame when the annuity is fully paid off and no further premiums are required. D. The period during which the insurance company can adjust the terms of the annuity. Answer: B. The period during which premiums are paid and the annuity grows in value, typically through interest or investment returns. Explanation: the accumulation period is the phase of an annuity when the annuitant makes premium payments or deposits in the case of certain variable annuities. During this period, the funds grow through interest or investment returns, depending on the type of annuity. G. Fixed variable. This phase is before the annuity starts making regular income payments, which occurs during the payout period. While the other answers are incorrect, A. The payout period is when the annuitant receives regular income payments, not the accumulation period. C. The accumulation period is when premiums are still being paid. It does not end when premiums are fully paid off. D. The accumulation period does not allow the insurance company to adjust the terms of the annuity. Terms are generally fixed at the start of the contract. Question 12. Which of the following annuity products typically offers the greatest potential for growth but also involves higher risk for the annuitant? A. Fixed annuities. B. Indexed annuities. C. Variable annuities. D. Immediate annuities. Answer: C. Variable annuities. Explanation: variable annuities allow the annuitant to invest in a range of sub-accounts such as stocks, bonds, or mutual funds, providing the potential for greater growth through market performance. However, this growth comes with high risk as the value of the annuity is directly tied to the performance of the chosen investments. While the other answers are incorrect, fixed annuities offer guaranteed interest rates, providing stability but with limited growth potential compared to variable annuities. B. Indexed annuities are linked to a market index like the S&P 500, but their growth is typically subject to a cap or participation rate, reducing the potential for high growth compared to variable annuities. D. Immediate annuities provide guaranteed income immediately, but they do not offer growth opportunities since they are designed to start payouts immediately rather than accumulating value over time. Question 13. Scenario: Sarah, age 55, is considering purchasing an annuity to help supplement her retirement income. She is primarily concerned with a stable income stream that will last throughout her lifetime. She is also cautious about market risk but is willing to accept some inflation risk in exchange for greater potential income. Which of the following annuity products would most likely be suitable for Sarah's needs? A. A fixed annuity with a guaranteed interest rate. B. A variable annuity with a focus on high growth investments. C. An immediate annuity with a life only payout option. D. A fixed indexed annuity with inflation protection riders. Answer: C. An immediate annuity with a life only payout option. Explanation: an immediate annuity with a life only payout option provides guaranteed income for the lifetime of the annuitant. This matches Sarah's desire for a stable income stream throughout her retirement, which is the primary goal. The life-only option ensures that she will receive payments for as long as she lives, which addresses her concern about market risk and provides stability. However, there is no provision for inflation protection, which Sarah has indicated she is willing to accept. While the other answers are incorrect, a fixed annuity provides a stable, guaranteed interest rate, but it does not offer income for as long as Sarah lives. It's more appropriate for someone looking for a predictable return rather than a lifetime income stream. B. A variable annuity involves investments that carry market risk, which does not meet Sarah's primary concern of avoiding market risk. D. A fixed indexed annuity offers potential for growth tied to an index, but Sarah has prioritized stability over potential growth. Additionally, the inflation protection rider may add complexity and costs that may not align with her needs. Question 14. Which of the following is true about death benefit provisions in a variable annuity? A. The death benefit is fixed and does not vary based on market performance. B. The death benefit is generally equal to the annuitant's initial premium, regardless of the value of the annuity. C. The death benefit can be adjusted to reflect the current value of the annuity, which can fluctuate based on the performance of the investments. D. The death benefit is not paid if the annuitant passes away during the accumulation phase. Answer: C. The death benefit can be adjusted to reflect the current value of the annuity, which can fluctuate based on the performance of the investments. Explanation: in a variable annuity, the death benefit provision typically allows the beneficiary to receive either the current value of the annuity, which can fluctuate based on the performance of the investments, or a minimum guarantee, whichever is greater. This makes the death benefit subject to the market performance, and it provides potential protection against investment losses. While the other answers are incorrect, A. The death benefit in a variable annuity can vary depending on the investment performance, so it is not fixed. B. The death benefit is typically not just equal to the initial premium, but could reflect the current value of the annuity, depending on the contract terms. D. The death benefit is typically paid out during the accumulation phase, but the exact amount depends on the contract terms and performance of the underlying investments. Question 15. Which of the following best explains the concept of tax deferral in an annuity? A. The annuitant must pay taxes on the annuity's earnings immediately, even if they do not withdraw funds. B. The annuitant only pays taxes on the annuity's earnings once withdrawals are made. C. The annuity is completely exempt from taxation during the accumulation period. D. The annuity's earnings are taxed at a flat rate regardless of when they are withdrawn. Answer: B. The annuitant only pays taxes on the annuity's earnings once withdrawals are made. Explanation: tax deferral means that the annuitant does not pay taxes on the earnings, interest, or investment gains in an annuity until they begin taking withdrawals. This allows the earnings to grow without being taxed during the accumulation period, which can lead to more significant growth over time. Once withdrawals are made, the earnings are taxed as ordinary income. While the other answers are incorrect, A. Taxes on the earnings are deferred until withdrawal. They are not due immediately. C. Annuities are not exempt from taxation entirely, rather they are tax deferred. D. Annuity earnings are taxed as ordinary income when withdrawn, not at a flat rate. Question 16. Which of the following is the main difference between qualified and non-qualified annuities? A. Qualified annuities are purchased with pre-tax dollars, while non-qualified annuities are purchased with after-tax dollars. B. Qualified annuities offer tax-deferred growth, while non-qualified annuities do not. C. Non-qualified annuities allow for larger contributions than qualified annuities. D. Non-qualified annuities are subject to stricter withdrawal rules than qualified annuities. Answer: A. Qualified annuities are purchased with pre-tax dollars, while non-qualified annuities are purchased with after-tax dollars. Explanation: the primary distinction between qualified and non-qualified annuities is the way they are funded. Qualified annuities are purchased with pre-tax dollars, e.g. through an IRA or 401k, which means the contributions are tax deductible, but withdrawals are taxed as income. Non-qualified annuities, on the other hand, are purchased with after-tax dollars, meaning the initial investment is not tax deductible, but the earnings grow tax deferred. While the other answers are incorrect, B. Both qualified and non-qualified annuities offer tax deferral. This is not a distinguishing feature. C. Non-qualified annuities do not necessarily allow for larger contributions. This depends on the specific account type and contribution limits. D. Withdrawal rules are not stricter for non-qualified annuities compared to qualified ones. The key difference lies in the funding method. Question 17. Which of the following is typically not a characteristic of a fixed annuity? A. It provides guaranteed interest rates. B. It offers the potential for market-based returns. C. It is suitable for individuals seeking predictability and stability. D. It generally involves low risk for the annuitant. Answer: B. It offers the potential for market-based returns. Explanation: a fixed annuity offers a guaranteed interest rate, meaning the return is stable and predictable. The annuity's value grows at a fixed rate, which does not depend on market performance. Therefore, fixed annuities do not offer market-based returns, and that characteristic is associated with variable annuities, where the returns are tied to the performance of the underlying investments. While the other answers are incorrect, A. Fixed annuities do provide guaranteed interest rates, ensuring a stable return on the investment. C. Fixed annuities are ideal for individuals seeking predictability and stability, as they offer fixed returns and a guarantee of income. D. Fixed annuities are low risk since the return is guaranteed by the insurance company, providing financial security to the annuitant. Question 18. Which of the following annuity types is most suitable for someone who seeks to protect their principal while still having the potential for moderate growth linked to an external index? A. Fixed annuity. B. Variable annuity. C. Fixed indexed annuity. D. Immediate annuity. Answer: C. Fixed indexed annuity. Explanation: a fixed indexed annuity provides principal protection, meaning the annuitant's initial investment is guaranteed not to decrease due to market downturns. The annuity's growth is linked to the performance of a specific market index, e.g., the S&P 500, offering the potential for moderate growth based on market performance, while still providing a safety net for the principal. Why the other answers are incorrect. A fixed annuity offers guaranteed returns but does not provide the opportunity for growth tied to an index. B. A variable annuity involves investments in market-based sub-accounts which carry more risk and may result in losses, so it doesn't provide principal protection. D. An immediate annuity provides guaranteed income right away, but it does not focus on growth or principal protection linked to an index. Question 19. Which of the following is true about annuity riders? A. Riders are optional and can be added to an annuity contract to modify its terms, such as adding income guarantees. B. Riders are mandatory provisions of all annuity contracts that adjust the payout rate. C. Riders can only provide death benefits if they do not alter any other terms of the contract. D. Riders increase the annuity's minimum guaranteed interest rate. Answer: A. Riders are optional and can be added to an annuity contract to modify its terms, such as adding income guarantees. Explanation: annuity riders are optional provisions that can be added to an annuity contract to enhance or modify its features. Examples of riders include those that provide income guarantees, death benefits, or even inflation adjustments. Riders allow the annuitant to tailor the annuity to their specific needs, but they typically come with additional costs. Why the other answers are incorrect. B. Riders are optional, not mandatory. C. While riders can provide death benefits, they can also be used to enhance other features, such as income guarantees or long-term care benefits. D. Riders do not necessarily increase the guaranteed interest rate of an annuity. They provide added benefits, but the base rate remains the same. Question 20. What is the primary difference between an annuity certain and a life annuity? A. An annuity certain pays benefits for a specified number of years, regardless of the annuitant's life. B. A life annuity pays benefits for a fixed period, such as 10 or 20 years, even if the annuitant dies before the end of the term. C. A life annuity provides income for a set term, such as 10 or 20 years, with no provision for the annuitant's lifetime. D. An annuity certain guarantees a fixed payout amount based on the annuitant's life expectancy. Answer: A. An annuity certain pays benefits for a specified number of years, regardless of the annuitant's life. Explanation: an annuity certain provides payments for a set period, such as 10, 20, or 30 years, regardless of whether the annuitant is still alive. If the annuitant dies before the end of the period, the remaining payments are typically made to a beneficiary. In contrast, a life annuity provides payments for the annuitant's lifetime, and payments stop upon their death, though there may be options for survivor benefits. Why the other answers are incorrect. B. This describes a life annuity with a guarantee period, not a standard life annuity. C. A life annuity provides lifetime income, not income for a fixed period. D. Annuity certain does not rely on life expectancy. It simply provides payments for a specified term, not based on the annuitant's expected lifespan. Question 21. Which of the following best describes the primary objective of annuitization? A. To convert a lump sum of money into a series of periodic payments for a specified period. B. To invest a lump sum in a diversified portfolio with high market returns. C. To guarantee the return of principal with no growth over time. D. To generate tax-free income for the annuitant during retirement. Answer: A. To convert a lump sum of money into a series of periodic payments for a specified period. Explanation: the primary objective of annuitization is to convert a lump sum of money into a predictable, regular series of payments, typically for a set period or the annuitant's lifetime. This process provides financial security during retirement by ensuring the annuitant receives a steady income stream. Why the other answers are incorrect. B. Annuitization is not focused on investing for market returns. It is about converting funds into regular income. C. Annuitization can guarantee a return of principal, but it often involves some level of growth through interest or other terms of the annuity. D. Annuities do not generally guarantee tax-free income. The taxes are typically paid on the earnings portion of annuity payouts. Question 22. Which of the following is not a factor that can influence the payout amount of an annuity? A. The annuitant's age at the time of annuitization. B. The annuity's initial premium amount. C. The length of the payout period selected. D. The market performance of the annuity's underlying investments. Answer: D. The market performance of the annuity's underlying investments. Explanation: for a fixed annuity, the payout is typically determined by factors such as the initial premium, the annuitant's age and the length of the payout period. In contrast, variable annuities are impacted by market performance since the value of the annuity is tied to the performance of investments. For fixed annuities, however, market performance does not affect the payout once the annuity is annuitized. While the other answers are incorrect, the age of the annuitant is a key factor in determining the payout amount, as older annuitants typically receive larger payments for the same premium. B. The initial premium directly influences the size of the payout, with higher premiums leading to larger income payments. C. The payout period selected also impacts the amount of each payment, as shorter periods generally result in higher periodic payments. Question 23. Which of the following is true regarding a qualified annuity? A. The premiums paid into a qualified annuity are subject to income tax during the accumulation phase. B. Distributions from a qualified annuity are generally tax-free. C. Qualified annuities are funded with after-tax dollars. D. Contributions to a qualified annuity are made with pre-tax dollars and distributions are taxed as income. Answer: D. Contributions to a qualified annuity are made with pre-tax dollars and distributions are taxed as income. Explanation: a qualified annuity is funded with pre-tax dollars, often through a retirement plan like an IRA or 401k. The contributions are tax deferred, meaning the taxes are paid when funds are withdrawn during retirement. Distributions from a qualified annuity are taxed as ordinary income. While the other answers are incorrect, A. Premiums paid into a qualified annuity are made with pre-tax dollars, so they are not taxed at the time of contribution. B. Distributions from a qualified annuity are taxable as income, not tax-free. C. Contributions to a qualified annuity are made with pre-tax dollars, not after-tax dollars. Question 24. What is the primary purpose of the death benefit in an annuity contract? A. To ensure that the annuitant's beneficiaries receive the remaining value of the annuity if the annuitant dies before annuitization. B. To guarantee a set amount of income for the annuitant's beneficiaries after death. C. To increase the annuity's payout amount after the annuitant's death. D. To provide tax-free income to the annuitant's heirs after death. Answer: A. To ensure that the annuitant's beneficiaries receive the remaining value of the annuity if the annuitant dies before annuitization. Explanation: the death benefit ensures that the beneficiaries receive the remaining value of the annuity if the annuitant dies before annuitization, i.e., before the annuity payments begin. This is typically a feature of deferred annuities and ensures that the annuitant's heirs are not left with nothing if the annuitant passes away unexpectedly. While the other answers are incorrect, B. The death benefit typically pays the remaining balance to beneficiaries, not a guaranteed income. C. The death benefit does not increase the annuity's payout after the annuitant's death, it simply pays out the remaining value. D. The death benefit does not necessarily provide tax-free income. The remaining balance may still be subject to taxation. Question 25. Which of the following describes a single premium immediate annuity? A. It requires a lump sum premium and begins payments immediately. B. It involves multiple premiums paid over time, with payments beginning in the future. C. It is designed for individuals who seek long-term accumulation of funds. D. It pays income only for a specified term, regardless of the annuitant's lifetime. Answer: A. It requires a lump sum premium and begins payments immediately. Explanation: a single premium immediate annuity is funded with a one-time lump sum premium and begins making immediate periodic payments, often monthly, quarterly, or annually, to the annuitant, usually starting within one payment cycle after the premium is paid. While the other answers are incorrect, B. A deferred annuity requires multiple premiums and begins payments at a later date. C. An SPIA does not accumulate funds for long-term growth but rather provides immediate income. D. SPIAs generally provide lifetime income or income for a set term, not just a specified term. Question 26. Which of the following is a disadvantage of a variable annuity? A. It guarantees a fixed rate of return. B. It provides no death benefit to beneficiaries. C. It exposes the annuitant to market risk with returns varying based on investment performance. D. It typically does not provide income during retirement. Answer: C. It exposes the annuitant to market risk with returns varying based on investment performance. Explanation: variable annuities are tied to the performance of underlying investments, such as mutual funds or other market-based assets. This means that the value of the annuity can fluctuate depending on how the investments perform, exposing the annuitant to market risk. While the other answers are incorrect, a fixed annuity, not a variable annuity, guarantees a fixed rate of return. B. Variable annuities do provide death benefits, which pay the beneficiaries the value of the annuity if the annuitant dies before receiving all benefits. D. Variable annuities can provide income during retirement, but the amount can vary based on the performance of the investments. Question 27. What does the annuitization period refer to in an annuity contract? A. The period during which the annuitant pays premiums into the annuity. B. The time during which the annuity earns interest and accumulates value. C. The period during which the annuitant receives income payments after the annuity is activated. D. The period during which the annuity's investments are converted to a fixed return. Answer. C. The period during which the annuitant receives income payments after the annuity is activated. Explanation. The annuitization period refers to the income phase of an annuity when the annuitant begins receiving periodic payments, e.g., monthly, annually, after the contract has been activated. This is the time during which the accumulated value of the annuity is converted into an income stream, while the other answers are incorrect. A. This describes the accumulation phase, not the annuitization period. B. This is also part of the accumulation phase when the annuity grows in value before payments begin. D. This might be true for some annuities, but it is not the definition of the annuitization period itself. Question 20. Which of the following riders would most likely be added to an annuity to guarantee that the annuitant will receive a minimum amount of income for their lifetime? A. A long-term care rider. B. A death benefit rider. C. A guaranteed minimum income benefit GMIB rider. D. A market value adjustment MVA rider. Answer. C. A guaranteed minimum income benefit GMIB rider. Explanation. A guaranteed minimum income benefit GMIB rider ensures that the annuitant will receive a minimum amount of income for their lifetime, regardless of the performance of the annuity's investments. This rider provides income security and is often added to variable or fixed indexed annuities. While the other answers are incorrect, a long-term care rider provides benefits for long-term care expenses, not guaranteed income. B. A death benefit rider ensures that beneficiaries receive the remaining annuity value if the annuitant dies, but it does not guarantee income. D. A market value adjustment MVA rider adjusts the value of the annuity based on interest rate changes, but does not provide income guarantees. Question 29. What does a market value adjustment MVA rider do in an annuity contract? A. It guarantees a fixed payout amount for a set term. B. It adjusts the value of the annuity based on changes in interest rates. C. It provides additional income if the annuitant lives longer than expected. D. It ensures that premiums paid into the annuity grow at a guaranteed rate. Answer. B. It adjusts the value of the annuity based on changes in interest rates. Explanation. A market value adjustment MVA rider adjusts the value of the annuity based on the movement of interest rates in the market. If interest rates have changed since the annuity was purchased, the MVA rider may increase or decrease the value of the contract if the annuity is surrendered or if withdrawals are made before the contract's term ends. While the other answers are incorrect, A. The MVA does not affect the payout. It adjusts the value based on market conditions, typically when the annuity is surrendered. C. The MVA does not provide extra income based on life expectancy, it's based on interest rate changes. D. The MVA does not guarantee a fixed rate of return, it adjusts the annuity's value based on market conditions. Question 30. Which of the following is true regarding the tax treatment of an annuity? A. Annuities are tax-free until withdrawals are made, and taxes are only applied to the principal. B. Annuities are taxed on a last in, first out LIFO basis, meaning earnings are taxed first. C. Annuities are always taxed on a first in, first out FIFO basis, meaning the principal is taxed first. D. Annuities are never taxed and grow tax-free. Answer. B. Annuities are taxed on a last in, first out LIFO basis, meaning earnings are taxed first. Explanation. When you begin taking withdrawals from a non-qualified annuity, the IRS treats those withdrawals on a last in, first out LIFO basis. This means that the earnings, interest, or growth are withdrawn first and are subject to income tax, while the principal, the amount you originally invested, is taxed last. The idea is that the investment growth earnings is considered income and is therefore taxed first. While the other answers are incorrect, annuities are not tax-free. Earnings are taxed when withdrawn. Also, taxes are applied first to the earnings, not just to the principal. C. Annuities are not taxed on a first in, first out FIFO basis. The principal is taxed last, not first. D. Annuities are tax deferred, meaning taxes are deferred until withdrawal, but they are not tax-free.